I'm Kurt Power, one of the IRA specialists here at Quest Trust Company. Very, very excited about tonight's presentation. One of my good friends in the industry will be giving a lot of great information, a lot of great knowledge to everybody. But before we get to that, I want to let you guys know a new promotion that we have going on. I'm going to sit back, play a brief video for you guys. So check it out. We'll be right back.
My goodness, another downturn for the stock market. How on earth am I going to make money and retire at this rate? There has to be another way to invest my money safely.
There is.
Who said that?
The disembodied voice in your kitchen.
Oh my! Wait, what other way is there?
It's something called a self-directed IRA.
A self-directed IRA?
Yes.
Well, what does it do then, huh?
A self-directed IRA allows you to use your 401k and IRA money to invest in alternative assets such as real estate, notes, and private entities. With self-directed IRAs, you can take control and diversify with alternative investments that you're knowledgeable about, without the uncertainty and fluctuation of the stock market.
Well, that sounds like a swell idea. How do I get one of those?
All you have to do to get started is open up an IRA with Quest Trust Company. You can speak to one of our certified IRA specialists and submit an application in just a few minutes.
How grand! I think I'll call them right now.
But wait, there's more.
There's more.
Don't get burned by the stock market. When you open up an account with Quest Trust Company, we'll send you a free toaster. That's right. When you open an account right now at Quest Trust Company, we'll give you a free toaster. All you have to do is use promo code TOASTER and call 1-855-FUN-IRAs or send us an email.
All right, guys. So as you can see, we love to have fun here at Quest Trust Company. So open an account. We send you a free toaster. Best thing about it is the thing actually works. I have one myself. So if you guys are interested in that, I'll share my information at the end of this presentation so you guys can get hooked up with an account and that free toaster. I've also got one of the other IRA specialists here at Quest Trust with me, Steve Sabaji, who works in our Austin office. He'll be moderating this panel. If you have questions, please put them in the Q&A, leave them in the chat, and we will get to those questions. But I'm really excited about tonight's presentation because we have with us Richard Wilson, who is the founder and CEO of the Family Office Club. I met Richard a couple of years ago. He is one of the brightest and best people in the industry that I've come across. So anytime he does a presentation for Quest Trust Company, I get very excited. And if you're on this presentation tonight, you're going to take away a lot of great information. So if you're a very experienced real estate investor, listen to what Richard has to say. If you're brand new to real estate investing and you want to know about some tips and tricks about how to accelerate your growth, listen to what Richard has to say. A lot of great information coming at you. But before we get to that, let me share my screen and we will get you some of the brief promotions that we have here. Juan, how's that look? All right, so this is tonight's $1 Trillion Mixer. We thank you very much for joining us. So who is Quest Trust Company? We're the largest self-directed IRA custodian in the state of Texas. We are the fastest growing self-directed custodian in the United States. We currently have just over 20,000 active investor clients across the United States. So though we are headquartered in Texas, we can do business in all corners of the United States. We currently have $2 billion in assets under administration, over 100 employees across our offices in Houston, which is where I'm located. We also have fully functional offices in Austin and Dallas with 34 certified IRA services professionals. So over a third of our staff hold that prestigious designation as a certified IRA service professional. And at any given time, we will have anywhere up to $350 million in undirected cash. So if you're looking for money for deals, Quest Trust Company can be a place that you can benefit from that. But before we go into any further presentations, you have to understand that Quest Trust Company does not provide any tax, legal, or investment advice, nor do we endorse any products, services, or investments of any type. We encourage all of our clients and our non-clients to do your due diligence. both on the investments that you're doing, but very importantly, people that you may be partnering with before entering into those transactions. We encourage you to consult your attorneys, your accountants, CPAs, financial advisors, your power team before entering into any type of transaction. So what is a self-directed IRA and why should you have one? Really, a self-directed IRA is no different. There is no legal distinction between the IRAs held at Quest and an IRA held at a Fidelity or a Charles Schwab. The difference lies in what you, the client, are allowed to invest in. With Quest, we are on the private side. We do real estate, notes, and private placements, Fidelity, Schwab, public, stocks, bonds, mutual funds. But some of the main benefits that we have to using a self-directed IRA are diversification. Ideally, you have both. You're not spread across, you're able to spread your risk when you have an IRA at a company like Quest and a company like Fidelity. You're able to ride that market volatility a little bit better the more risk that you have spread. Tax savings, depending on the type of account, you may get a tax deduction for that contribution. But it's also a great tax shelter when we're talking about the earnings that you make from your investments when you're utilizing a self-directed IRA. Social investing is very important to Quest. We believe in giving back to the community. And when you're using your IRA to do investments in your community, not only are you giving people a second chance at putting a roof over the head, you maybe are potentially hiring contractors, landscapers, roofers. You're giving back to that local community by providing job opportunities for the projects that you are doing. And the last one is investing in what you know best. We could sum this up in one word, it would be control. You as the fiduciary to your account are truly in control of the investment. So if you're a real estate guy or girl, you get to take those funds that are in your IRA and truly invest them in vehicles that you know best. We have seven types of accounts at Quest Trust Company that can be self-directed. We break them down into three categories. We have our personal plans, which are the traditional Roth IRA, employer plans, which are the SEP, Simple, and Solo 401k. And lastly, our specialty plans, the Health Savings Account, Coverdell Education Savings Account. Give us a call, guys, 855-FUN-IRAs. Reach out to us at IRA specialists at questtrust.com. Reach out to Steve Sabaji, who's moderating this panel tonight. We give away our education. We give away our time. It doesn't cost you anything to have a consultation with us. So whether you are somebody who is looking to roll over that old 401k or transfer that IRA from Fidelity or Charles Schwab or your Roth IRA, we can help you with that. If you're an individual who is truly self-employed, these types of plans are for you. Maybe you don't have that traditional W-2 job. Maybe you don't have that traditional 401k. These types of plans are for you because they help you direct your funds to invest, again, in things that you know best. And our specialty plans, these are special plans for special purposes, the Health Savings Account and the Coverdell Education Savings Account. With the Health Savings Account, you can potentially get a tax deduction on your contribution and turn around and use those funds completely tax-free for qualified medical expenses. A Coverdell Education Savings Account, this can be used completely tax-free for qualified education expenses. So it's a little bit of a shift in mindset that maybe you could be paying for your everyday expenses, both medical and educational, with tax-free dollars. When you have a self-directed IRA, your investment choices are really limitless. But at Quest, we focus on real estate, private entities, and promissory notes. As you can see by the breakdown, a whole slew of things that you have the opportunity to not only educate yourself, but also take part in investing in things like single family, foreclosures, limited liability companies, limited partnerships, and even notes, secured or unsecured, mortgages, shared appreciation, net profit notes, even things like oil, gas, mineral rights can all be utilized with the self-directed IRA. And those accounts that we just talked about, they can be self-directed individually, or they can even be partnered together to take part in these types of investments. So some of the things that we have been building at Quest Trust Company, we've put a ton of emphasis on our technology. This has been a huge push for us. And the Quest Trust Company client portal really puts the control truly in your hands. This is very similar to if you have a checking account, savings account at a Bank of America or Chase, you can literally go to that website or that app any point in time and see what your account is doing. With the Quest Trust Company client portal, you can see in real time what your investments are doing, what your balance is. money going in, money going out. This is something that we are very, very proud of, that we've built a very robust client portal for you to truly be in the driver's seat and handle everything at your disposal. But we don't stop there. We offer endless free education. Just like the presentation we're going to have tonight with Richard Wilson, we educate all the time, guys. If you want to keep what you have, you got to give it away. That's a philosophy that we very much believe in. You can go to our YouTube channel where all of our classes air live. If you miss it, you can always go back to YouTube. They are all archived there. Our education center on the Quest Trust Company website, you can see our archive classes taught by Quest executives and other IRA specialists, and many different educational articles that you can read. We are constantly educating you both visually with class presentations, but also with written presentations as well, written blogs. We also do weekly webinars every Tuesday, Thursday at 12 noon. We have our virtual networking happy hour the first and third Wednesday of every month, and self-directed IRA Saturday, every Saturday at noon. My friends, this is where you want to be. If you want to network, build your power team, find potential partners, find deals, find access to money, Quest can help you with all of that. Though we can't give you tax, legal, or investment advice, we can provide you networking, education opportunities that can help you grow your retirement accounts. And we're very excited that after almost a year and a half of doing everything solely virtually, we're grand opening again. We're announcing right now, Austin, August 10th, Houston, August 3rd, Dallas, August 17th. Back to our in-person networking events. If you're in Houston, if you're in Austin, if you're in Dallas, please go to our website, questtrustcompany.com. Register to be back in person. We can't wait to see you all in person again. Though Zoom has served us very well, I think we're all ready to go back to in person and start shaking hands, meeting people face to face, and doing things the way we've always done it. So we're very, very excited about this. Please register. Go to questtrust.com. Make sure to be there, guys. Look forward to meeting you all in person. We are actually giving you money for deposits. Whether you're a new client or an existing client, we are giving you money for any qualified deposit. So you can see the breakdown here of what your account credit would be and for a qualifying deposit. If you're a new client, use the promo code REWARDS21 on the application to receive your credit. If you're an existing client, please email us at sales@questtrust.com to receive that credit. We're literally handing you guys money to put deposits in there and get your IRA to work. So don't miss out on this opportunity. Last thing, guys, we're referring friends. So if you refer a friend to Quest, again, we are giving you account credits. There is no limit to this. So for every person you refer to us, we are going to credit you $25. And when they open an account, they are also going to get a $25 credit. Every single client you refer to us. There is literally no limit to how much you can do with this. And lastly, guys, you saw the video at the beginning. Don't get burned by the stock market this summer. When you open an account with Quest Trust Company, we're going to send you a free toaster. This is one of the most fun promotions I've been a part of since I've been at Quest. Guys, we make IRAs fun. 855-FUN-IRAs is our phone number. This is an extension of that. We have a fun culture here. We love to talk IRAs and help people save for their retirement. And this is just a fun promotion where you can get a free toaster for opening up an account. You can chat with us, a live IRA specialist, questtrust.com during business hours. A live certified IRA specialist is there to answer your questions. Again, give us a call, 855-FUN-IRAs. You can also email any of our certified IRA specialists at iraspecialists@questtrust.com, or you can email me directly, kurt.power@questtrust.com. I know Steve is on the chat right now, moderating this panel. He shared his information. Reach out to him. Use him as a resource. Not only is Steve one of the best IRA specialists at Quest Trust Company, he's one of the brightest IRA professionals in the United States. So utilize him. Utilize us at Quest Trust Company. We're here to help you. So that's all I've got. So again, tonight we have Richard Wilson from the Family Office Club. He is the CEO and founder. Richard, it's good to see you, man.
So Kurt, thanks for having me here. Appreciate it.
Yeah, it's always good to see you, man. I haven't seen you in like a year and a half, but it's good to see you again right now.
Yeah. A little hard to follow the so excited to meet in person. yet. We're on one more Zoom, but I'll try to make it concise and deliver a lot of insights per minute if I can here.
Well, I always learn something whenever we talk, whenever I go to one of your events. It's always educational. So I'm always thrilled when you're on here. I think anybody who's listening right now is going to get a lot of great information. So Richard, take it away, my friend.
Awesome. Happy to. Thanks, Kurt. Thanks everyone at Quest Trust. I've really enjoyed getting to know the whole Quest Trust teams. I'm sure many of you listening have. They've been great to work with today. So today I'm going to be talking about hard money loans. But before I go into that, I just wanted to give a quick introduction and background, just to give you some perspective on the comments that I make about what I see our investors investing in. So similar to Quest Trust, we run an investor platform. We just don't do any self-directed IRA work. We run an investor club. And I started it 14 years ago. We have 16 full-time professionals on our team. Some of the platforms we run are familyoffices.com, where we offer 20 live events a year. We also run commercialrealestate.com, where we do a quarterly commercial real estate conference. Last week, we acquired billionaires.com, and we have over 500 investors registered with us on investorclub.com. So the ideas from the presentation today, it's important to state all that because the ideas come from us hosting 150 live events over the last 14 years. And these ideas come from the text message I had today with a $30 million net worth investor in Texas. And I just got a response back from someone who's a $2 million net worth investor in Australia. And we're always structuring multiple deals at a time or closing multiple deals at a time. We keep our attorneys well fed doing that with our clients, but we're always learning something new. And selfishly, that's why we continue to host our live events, is that I get to script the discussion panels of what the investors get asked on stage, and we get to just learn as the audience learns at our investor club events. And through investorclub.com, which is the investment portal for our RIA, which is Centimillionaire Advisors, we have due diligence investment opportunities there that are passive for investors who want to invest in operating businesses or real estate that's typically cash flowing or is a hard money lending opportunity like we're going to talk about today. In the operating business side of things, we're most focused on healthcare. And within healthcare, most focused on dental clinics and chains of dental clinics because they're relatively stable businesses that are getting increasingly high valuations. And we've just really enjoyed working with a lot of doctors and dentists over the past several years. So that's it for my intro. Let me share my screen now so you can see my PowerPoint. And I think the last time we did one of these presentations, we only had 1 or 2 questions. So if you have any questions as we go, please just don't be afraid to ask them. You can post it privately or publicly in the chat thing, and we'll try to keep an eye out for that as we go through here. So just like what Quest Trust said about their disclosure, any webinar or live conference you go to that talks about an investment strategy, it is not a recommendation that everyone here should go do that investment strategy. It's never the case that an investment's going to be right for everybody because I don't know who you are. So obviously, none of this is legal advice or investment advisory advice because I really don't know your situation and this might be too risky, or even though we're going to point out how it's not super risky, or it might be not in line with your timeline or your goals or what's appropriate for you or your level of accreditation, et cetera. So just have to say that up front before we get started. Okay, here's a picture of our team. We've had over 1,000 ultra wealthy investors and family offices on stage at our events, over 150 live events. And we've met with now probably around 4,000, maybe more investors in person, face to face. I just spent 4 days in Park City with 100 plus private investors teaching a workshop there. And as I mentioned before, that's where the ideas come from here today. So to give a little bit of a framework for what we're going to go into, there are many types of real estate investments for you to choose from as a private investor. Anything from investing in agriculture and land to residential real estate, commercial real estate, and even within commercial real estate, there's many niches within there: shopping centers, hotels, and hospitality, medical office buildings, self-storage has been a very popular area. Multifamily is probably the most popular syndicated deals among private investors, and industrial has been very hot. Those are types of real estate, but there's also types of structures. And hard money lending is a type of structure, and it's typically pertaining to one type of real estate, single family residential, but not always. You can do commercial hard money loans as well. But if you take the type of real estate and put that to the side, there's different ways to be investing in real estate structure-wise. There are equity investments you can do. So you have an equity share in a property. There's syndicated equity, where it's not just your own capital going in, but maybe there's 20 other investors or 200 other investors coming into that same deal. There's unsecured debt, secured debt, which would be debt with collateral behind it. Maybe making just a straight loan with collateral behind it. Mortgage notes, and this might be a traditional mortgage that you might make to someone who doesn't qualify for a bank mortgage. And that's a whole kind of niche industry to itself. Auctions or REO, and foreclosures. Some people go to public auctions to get foreclosed properties as their strategy, and hard money lending. So you could spend your whole life only mastering investment into self-storage and still learn new things as you learn how to build self-storage or renovate it or retrofit it to be more clean energy efficient, et cetera. So this is why it's very challenging for private investors to know about all these areas. And we usually encourage private investors to study enough of these areas to pick just 1 to 3 that they're going to attempt to learn much more about. And maybe your investment advisor points you to 1 or 2 that are a good risk-adjusted approach for you. If you don't have someone advising you, we do help investors select a traditional wealth advisor or wealth manager. That is not what we do. What we do is help source direct investments, but we coordinate very closely with wealth advisors. And sometimes the partners we can bring to the table for wealth advisory makes it so we could have a meeting with the wealth advisor and our team in the same room, and just makes it that much easier for things to go forward. But the main point of showing this slide is just that it is almost impossible for anyone, even if you're full-time only investing in real estate and you have retired or sold your business, to know enough about hospitality, office, land, medical office building, self-storage, industrial, to be highly effective in these areas. So you have to be passive in almost anything. And I would encourage you to pick your battles of where you're going to move up the learning curves on these different strategies and different areas. Some current real estate investment trends that we've been seeing through hosting some of our events. Right now, obviously, low cap rates, high prices. Funds with 4 to 7 year holding periods are very common, which is on contrast with what we see in hard money lending opportunities. We see a lot of returns. In any point in time, the returns are typically based on the last 7 years, the last 10 years, the last 12 months, or since inception of the strategy or the fund or the organization. So obviously people are going to look at how things have gone the last X number of years. The problem with that is that when things have gone very well, which in some industries, I know it's been a roller coaster, but in others it has gone very well, then you have to be certain that you have to wonder if you can be certain about the returns being sustainable. Someone might say, oh, well, we've been returning a 20% IRR. Well, maybe they started in 2011 or 2010. And since then, it's been a great market. And as long as they didn't sell during a little bit of illiquidity during the middle and early part of COVID, maybe their assets are at record highs again. But will that continue forever without a big dip at some point? Or will they be forced to sell in the future based on loan covenants in the future? Nobody can say, but it's very unlikely that things keep going up forever. So that's something that's top of mind with current real estate investors right now. The last thing I mentioned here is that there are so many wealth advisors and investment bank or private banks out there that will manage your wealth and have access to many different investment funds on their platforms, that the investment space is a bit commoditized, meaning that if somebody has a fund and they want you to invest in their real estate fund, it can be challenging to decide which one to choose. So if you go to the bank, they're going to have 5 different funds or 50 different funds that all have $1 billion plus in assets. And somebody has highly due diligence those probably. They might provide not as high returns potentially as a smaller firm, but much, much less likely to just randomly go out of business or randomly not communicate with you. Or they're much more established groups. And what I've been finding among wealthy clients as a trend is just that they want to go direct into deals more often. They want to do things like set up their own self-directed IRA, do a direct investment into an apartment building downtown, or go and acquire a self-storage property, or at least find a sponsor and they can choose which deals of that sponsor they want to invest into. And I feel like that trend is becoming stronger and stronger. And so we're going to talk about, and that's partially why I wanted to do this presentation on hard money lending, because when I think about how to add the most value to our clients through our investorclub.com platform, I think, well, why should I waste my time providing them something that they can easily get through a banking platform or easily get from any number of private banks? So what is a hard money loan? The very base definition of a hard money loan is a loan that has a hard asset backing it. So just think of a collateralized real estate loan, or if you understand that most hard money loans are provided to people who are fix and flipping single family residential homes, then it makes it very easy to understand. So if you were to buy a home for $100,000, and typically the homes in the area were selling for $250,000, but you had to gut the inside of this 1,500 square foot house, you might spend $100,000 renovating that house. And so when you buy it for $100,000, you might say, well, I need to get a hard money loan so that I can renovate this property and then sell it for that $50,000 profit. And so the borrower is going to a private investor or a hard money lending company or investment firm, and they're not applying based on their credit score. And while their reputation and their credibility and their team does matter a lot, what matters the most is the actual asset. And so investors make hard money loans on assets they understand how to liquidate, because that's their security. And they make them in a short period of time. Sometimes these can close in as little as 3 to 4 days for repeat borrowers, as little as 2 to 4 days. Depends on how fast the title company can move and documentation is in place. This can close very quickly. 7 to 14 days is very quick compared to normal 30, 60, 90-day closing on traditional financing for real estate. So that's one reason why these are popular. And the other reason is that the person who is fix and flipping a property, let's say that they borrow $100,000 at just for easy math, let's say a 12% rate, well, then they're going to owe $12,000 after 1 year to the investor that they borrow that money from. So if they're going to clear $50,000, well, now they use the money of that investor and they got to keep the lion's share of that $50,000 upside. They only had to share $12,000 of that. So they got to keep $38,000 of that upside, assuming that $100,000 was their total all-in cost in that renovation. That's the attractiveness of investing this way. And one of my clients has done 140 hard money loans, and they have the discussion of like, well, maybe we should be taking equity in all these things and just splitting the equity 50-50, because then we would be, sharing the $25,000 upside, not the $12,000 upside. But it gets more messy. You've got more liability potentially when you go in as equity instead of a hard money loan. So there's a couple important terms related to hard money loans that are really critical to understanding how they work and why they're relatively protected. And we'll go into the risks in a couple slides. So typically 60 to 85% of the loan to value ratio, or LTV, loan to value is often referred to as LTV, is typically the range that people will lend at. Most are done at 65 to 75 or 70% LTV. And what that means is that if the house is worth $100,000, then typically the investor will lend $60,000 or at most $85,000. Depends how hard that investor is having to work to get that loan secured and how much risk they're willing to take. And if you think about it, if the biggest market drawdowns in most markets draw the price of real estate down by 35% or 30%, then if you had an LTV of 70%, even in the worst of markets, conceivably, this is not an absolute, this won't be true in all cases, of course, but even in the worst of markets where things go down 30%, 35%, well, if you loaned at 65% and things go down 35%, you could still break even in theory if you needed to sell. The reality is most people making these loans are wealthy investors and they can deal with some illiquidity. So they may have to foreclose on the house that they loaned the money to flip to the investment firm that was borrowing the money, they might have to foreclose on it. And at that point in time, maybe it's gone down 30% in value, but they could probably afford just to wait and hold it and rent it out in Airbnb or rent it out annually. And when it recovers back up to 100%, then they could sell it off or just keep it if they want to. So the point of the 60 to 85% loan to value ratio is to protect yourself in case the buyer overpays, in case they start to fix the property they were trying to flip and they never finish and now it's half done. And now you've lent it 85% of the value and the renovation's not even done and the money's been burnt. Well, you might have to put in another 15% of value just to get it rentable again. Those are typically worst case scenarios, but they do happen. And many times there are times when the project doesn't get done on time due to permits, due to supply problems or lumber costs, et cetera, or costs get overrun. And then they have to extend the loan and you get a higher percentage return. Typically in a hard money loan, well, the market's gotten a lot more competitive on this. It used to be that you could get 13 to 15% on hard money loans. As the market's gotten a little bit tighter and more competitive, and a lot of these are getting done all of the time, I've seen hard money loans as low as 7.5% to 9%, but that's very low. Most investors don't want to do them unless they're getting a 10% return. And sometimes you get as high as 11 or 12% still. But 10 or 11% is really the market for a private investor's experience in a hard money loan that was arranged by a professional in the industry who's doing these all of the time. The other thing that's important to explain about hard money lending is that you are in typically in first position in the real estate, meaning the real estate does not have any other debt on it. And many times you have the personal guarantee in there as well, which may or may not mean much depending on who the person is and what their personal assets are. But if you're in first position on the deed to the loan on the property, then just like a bank, if payments aren't made and you follow the process described in the agreement, then you could foreclose on the property as needed. To give you a case study on this, the reason why we're doing this presentation here today is that we've had a lot of our investors request access to hard money lending opportunities. And while at a business owner club event last year, I met someone who has done over 400 hard money loans. We met him in person. We met him in person again. We then had a professional athlete reach out to us through their banker, asking us to help them source a hard money loan. And we said, well, we won't do that directly, but we know someone who specializes in that. And they were able to complete that loan for the athlete. So we got to know him that way. We then conducted a background check on this professional and looked at their track record. And the statistics that they've shared with us is that out of 400 hard money loans that they've made, and I think it's $78 million in volume, they've only had 2 issues, and they were able to work those out to get back a good amount of the initial investment. So they have a good track record in the space, and it just helps that you have this ability to acquire the piece of real estate as a worst case scenario. Many investments don't have that. You invest as equity, your equity get wiped out. If the group can't afford to pay the loan payments, the bank will acquire that self-storage property or that house or that multifamily property, and now your equity is wiped out completely. Or the market goes down, you're forced to sell, and you might lose 30% or 40% or more of what you invested. Obviously, with an operating business where there's not a hard asset, many people do lose 100% of what they invest in more risky startups or angel investments. They go through an example now, and they go through some risks, but feel free to ask questions as we go here. Okay, so here's a summary of a typical loan. It says the borrower's purchase price, $155,000. The loan funding amount, $130,000. So the loan to cost ratio is 85%. The duration of the loan is there for 1 year, $240,000, meaning that if somebody rehabbed the property half of the way or all the way, but they weren't able to sell it or not able to sell it in time, well, now the loan to value ratio is all the way down at 55%. Most people don't go in higher than this 85% on this example shown here. I've never seen one that goes higher, and I wouldn't recommend it in case you get into negotiating one of these yourself. One thing to know is that on top of the 9, 10, 11, 12, 13% plus that might be charged to the person borrowing the money. In the case of the hard money loan, they might get charged 1 or 2 points up front. And the way the industry works is let's say there's ABC investment firm. ABC investment firm is going to make their money off of those 1 or 2 points charged up front, and then a little bit of a spread of maybe charging that person 14% for their cost of capital and giving investors a 11% cost of capital or something of that nature. And that way they can run their business and make their money sourcing these and structuring these loans while protecting their investors by helping paper the hard money loan with a title attorney and having the right documents in place so you're protected in case you don't get paid as you're supposed to. So just like any investment, there's many different types of risks, and this is not exhaustive, but it's not riskless. Some people talk about hard money lending as if nothing ever can go wrong and you could never lose your money. That's not true with any investment. With any investment, there's a risk of fraud. There's a risk that everything they told their accountant was not accurate. Whatever they told the due diligence firm that did a report on them wasn't accurate. They could have lied in their track record. They could have fudged numbers. So that's obviously always a risk out there. So always do background checks and get to know someone over a period of time before investing. Lengthy foreclosure process could be a risk. There may be rules against certain types of foreclosures in your area during COVID. It most likely will not apply to this situation because fix and flips are not inhabited. But there could be lengthy court processes if someone tries to fight you on this, or they lawyer up and try to prevent you from moving forward with the foreclosure. So if you don't have experience with that, you just have to seek out someone who has deep expertise there, because most of us have not had to go through that process. The good news is you're not foreclosing on someone and kicking someone out to the street. You're foreclosing on someone who didn't fulfill their promise of, fixing up the property as promised. Also, and this typically people in the fix and flip business are doing multiple projects at a time. It's not sinking their whole ship if you do have to foreclose on one property. And typically the threat of foreclosure makes them just work out a deal and you get it figured out. Documentation mistakes is one of the bigger risks that could sneak up on you if things aren't done right by someone who's new to hard money lending. They might make a very basic mistake in the documentation that stops you from being able to foreclose, or just stops you from getting the return you wanted. Poor communication can be a challenge just with the hard money lending firm you work with, but also the group you're lending to. There might be delays, and if those delays aren't communicated, you might wonder where your monthly payment is, or if you're not getting reports, or if you're not getting an update on why something is late, or what's the next step to de-risk the situation. That can be a source of stress and risk if you invest in this area. Market risk is obviously a risk. If the market goes down a record 50%, which seems like crazy, but in Scottsdale, it just went up 40% in the last 12 months alone, not to mention the last decade. So could it go down 50%? Yeah, for sure it could. I doubt it will, especially with inflation. It's probably going to keep going up, most likely, but I don't have a crystal ball. It could very, very likely also go down greatly. So it is a risk. After repaired value estimates is something just to watch out for. If somebody says, oh, we lend at 85%, but they're lending at 85% after repaired value, ARV, that means in this previous example, they would have lent the person $210,000 to buy a $155,000 property. And the person fixing it up would have no risk, no skin in the game. And they, could just be taking all the risk on the investor. And it would be leaving you in a bad position if they didn't fix it up and just left with your money. Now the asset that's supposed to be securing your investment is actually 33% less. You've actually loaned at 133% of LTV if you loan based on ARV. So you have to watch out for that. Someone told me just 2 weeks ago, they said, oh, well, we've got this property and the loan to value is 80%. And I looked at it and I was like, oh yeah, but that's loan to after you've done $400,000 in improvements value. That's not the loan to value right now. So if you fail, we're stuck without a chair to sit on when the music stops. So you have to really watch out for that, and just know that it should be based on the value before you've done anything to the property. The whole point is that if they fail to improve it at all, that you're relatively safe. The last thing to watch is LTV creep, meaning that to win deals over in such a competitive market, and as houses become more and more expensive, there's going to be groups that start lending out at 90 and 95% LTV, arguing that with the market momentum and ARV numbers that everything always works out. Well, it works out till it doesn't work out, and you don't want to be the investor it doesn't work out for. So just be cautious on that. So I'll look through and see what your questions are now. I see a few popping up here. Key default, in default, what are some types of documentation mistakes you have seen? Biggest one I've seen is the wrong LLC or the wrong name on the actual documents, which sounds silly. But when you are moving quickly and you're closing these in a 7-day time frame, and you might have 4 closing in a week, if you're an investment firm doing this, you need to make sure that your attorney reviews them when you get them from the hard money lending firm. And you need to look for the very basics of it being actually filled out for the right counterparty when people are moving too quickly. That can be a mistake. The other one is just having the right county, the right legal jurisdiction, the right process for resolving disputes with the right county. That's not going to make it painful and hard for you to actually move forward with the foreclosure process or any sort of legal action that would be needed. I had a question here from John. Is it not typical to expect charge points in these deals? Yeah, John, it's definitely typical. The most I've heard is 3 points being charged. The least I've heard, some people do it with no points, but almost nobody. Everyone usually charges 1 or 2 points. Sometimes those points are given to people who help source the deal. Otherwise, I help with the infrastructure and cost of servicing that loan. And then there's some investors who source, provide the loan, keep the points, and they are the investor. But a lot of private investors source these through an intermediary that specializes in structuring and sourcing hard money loans. And they run out of their own capital at some point, so they start raising capital from other investors. Another question is, have you had experience in deed in lieu of foreclosure clauses in states with a moratorium on foreclosure? I have not had experience with that specifically, but I'm happy to connect you with Matt, who runs a hard money lending firm, who's done 400 of these. He's based out of Utah. And he's the one where the only thing we have left to do to conduct our final due diligence on him is checking of 2 references. Otherwise, our due diligence file is complete on him, and we're going to be adding this hard money loan lending provider to our investorclub.com platform here very soon. But I'm happy just to have you ask the question directly to him and get an answer on that. I know in some states you're able to, if it's a large hard money loan, such as a commercial real estate property, you can get a judgment from a court that the loan documents and is it set up correctly, and that the judgment already shows that based on the legal documents shown, if there is a default and if you're not paid on time, that the foreclosure will go through, and the judge has predetermined that things are set up correctly and that you are able to foreclose if this series of events happens. That's an extreme thing to do on an asset unless the asset is unless you're lending $3 to $5 million or $5 million plus. But I have a large private investor who's done that on deals before, just to have the ultimate level of security. But you might spend $100,000 or $50,000 going through that process. But if it helps you sleep at night, because it's a large amount of money, it could be worth it. I've seen a small equity percentage when lower interest rates are negotiated. Can you say that a different way, Timothy, just so I make sure and get what your question is? I'm not sure I understand exactly what you're saying there, but Jeff has a question. Is your company help set investors up whole life insurance policies to use the cash value of the policy? No, we have not. We haven't worked with whole life insurance policies with our clients, but many of our clients do work with insurance experts and do that to access capital for investments, similar to how Quest Trust is one of the top firms in the self-directed IRA space. We don't do that either, but we do coordinate and work with investors that use self-directed IRAs fairly often. We have a couple more questions here. How do you handle usury law when you're charging 14% and 3 points and the loan is less than 6 months outstanding? The loan is 12 months. Some have a penalty if you extend it to 18 months or 24 months, but it's typically a 12-month loan. Some people by default do a 24-month loan, but that's like 5%, 10% of those out there. Might happen more in a commercial ground up development, which is really not the core of hard money lending. But almost everyone I know is going for 12 months. In terms of the specific usury laws, I have a investment in a fintech company that navigates those constantly all of the time. And we're registered in 32 different states and have to abide by those. So there's something that we have to pay attention to all the time in that fintech business. For the hard money lending business, there'd be another question I'd pose to Matt on how he has navigated usury laws, but I'm not familiar with what they are in Utah based versus where I'm at in Arizona, for example. Do you have a quick formula to process or calculate the out-of-pocket money on a typical fix and flip? Many times, Bobby, many times the fix and flippers that I know of go for the most damaged, broken down properties possible to leverage their skill set and capture more of that upside. So one of them I know that has maybe a $15 to $20 million net worth. They are going for burnt down buildings, or roofs caved in, things that the average mom and pop investor doesn't want to touch with a 10-foot pole. And that way they get discounted more and they can leverage their construction crew, keep them busy, and improve the property. That said, if you don't keep your renovation construction crew busy, they will leave you. They're typically 1099 contractors, and you can't have them just sitting there idle. And so what happens in the industry is that while they would like to do those projects most often, they sometimes have to do projects that are relatively easy, simple, and they can get in, fix it, and then flip it relatively quickly. So that's why it's a little bit hard to answer that question. Sometimes it can be, like I said before, it can easily be $100,000 on a property that may only be worth, $200,000 or $250,000 after fixing up the property. So it could be 30, 40, 50% of the value of the property. It just depends on the region and size of the property and how distressed of a deal they're able to get. Have investors been able to get equity on the back end when the loan rate is 7 to 9% to make up the difference? I have not seen an investor able to do that, Timothy. I have seen someone in the fix and flip space, though, that went to investors and said, we charge no fees up front. We are not going to give you a monthly payment back like a hard money loan, but we are going to share the profits with you 50-50. We do the work and find the project. You provide the capital. We split the profits, and every 6 months they flip the house. So 6 to 8 months on average. So you usually get 1.5 to 1 3/4 turn of your money every year. And so if you kept your money in there, then they would be continually trying to turn it over and increase your returns and reinvest it, increase your returns, and you can just choose to opt out and get your money back when you want to. But I will give you 5% or 10% of our profits. Someone's doing that, but most people just do a clean hard money loan or a clean equity or a clean profit split, and it makes it more simple and easy to explain. I think we had one more investor come up. Oh no, I got all the questions now. Cool. Any other questions come up, just please let me know, and I'll wrap up here pretty soon. So how do fix and flippers and others use hard money? The pros of using hard money is that people who are borrowing can get it without having to do so based on their credit. They might have 20 other fix and flip projects going on, and they can fund number 21 by going to a hard money lender who's fine with that and sees them as a professional in the space and is feeling secure because of the asset, not because of their credit. Faster approval and dispersal times than normal debt, and potential for a flexible repayment schedule, meaning that if you work it into the agreement, then okay, it's a 12% or a 14% cost of capital for a hard money loan, but we'll pay you 16% if we need 24 months instead of 12 months. The cons would be much higher interest rates than normal debt, of course. Otherwise, it wouldn't be interesting to you as an investor. You risk your collateral if you're the one borrowing the capital. And if the market shifts on you heavily, then you might be caught in a really tough spot to see the project through and make any money. You might be in a spot where if you didn't put a lot of money down into the project, you might be doing just well abandoning that project to focus on 3 others that could actually make you money if you see them through, versus pouring money into something you might just break even on and it's taking your time and money. as a real estate flipper. Benefits to investors, that's a 1-year term. So when I talked about trends in the industry, and I mentioned 4 to 7 year, 10-year terms on funds, the world changed so much the last 18 months that I'm feeling like investors like things where they're in and out in 1 year, or they're in and out in 6 months or 2 years, because the world changes so quickly. And many things do, like when you invest in a company, your money might be in there for 5 or 10 years. And so it's nice to have some investments that, besides the stock market, you can take out within 1 year. Consistent returns. Obviously, someone could choose to stop paying you because there's a problem with the property, but typically you're getting a monthly wire transfer back the first month right after you make that investment as a hard money investor. Collateral, it's obviously nice to have when you're investing in something. The more as often as we can, we try to structure collateral or some sort of asset to back a lot of the deals that we do. Diversity across 4 or 5 deals with just $1 million invested. It used to be you could just put $100,000 to work in hard money lending, and sometimes you still can do $75,000 or $100,000. But benefit number 5 talks about how a single investor in a single asset, and you're not mixed in there with 30 other investors. So if you need to foreclose, it's you foreclosing on this one property at this one address, and you're not mixed in there with a whole class of people. And that can make things more simple. And then you know that that asset is the one that you lent against, and use that in your criteria of whether you want to do that deal or not, and just feel more comfortable because of that. Right now, some hard money lending deals have gotten so large that the minimum you can invest is $200,000 or $250,000, because that is how expensive some of the houses have gotten in many of these markets. And so to get diversity in your real estate portfolio, you could add in a few hard money loans. Or if you have, enough money to invest that you decide that hard money lending is one of 2 or 3 areas that you really want to learn more about and that you like to add some diversity versus just doing equity investments passively, then you could get diversity by doing 2 to 4 of these types of deals in different suburbs or in different cities, et cetera. I already went over benefit number 5. Number 6, that you're in first position typically. Watch out for if you're not in first position. I would be hesitant to do a deal where I'm in second position unless there's just a lot of skin on the table for the sponsor to lose or for the investment firm to lose otherwise. And most have never heard of a hard money loan. I just find most investors I talk to have never done one. They've never structured one. They've never considered investing in one. And those who have spent a long time in the real estate industry know all about hard money loans, but most private investors know nothing about them, which is the point of the webinar here today. So I was glad that we had some questions along the way. That's awesome. If there's any more, feel free to send them in now. And before people start jumping off and I answer these questions, but if you do want to get to know us better, just head over to investorclub.com. It takes about 2 minutes to sign up there, and it's free to do so. We can get to know you a bit better, and then you get access to our investor summits for free as well. Let me see in the Q&A. What are the key items to include and exclude in these loan agreements of participation if the loaner is using IRA funds to avoid not being a passive investor? John, I have some of those in bullet points via email that I sent over probably a week ago to another investor. So I can shoot that over to you if you want to shoot me a note, because when I got asked that, I had to go to our expert in the field and get an answer from them. So I'm happy to share that with you. I just don't have that email open up in front of me here. And I think, Kurt, I think that Haley mentioned, if I'm not mistaken, that there are some other hard money loan and mortgage note providers, I think, on the Quest platform, or that you guys have had people use their self-directed IRAs for hard money loans in the past, right?
Yeah, there definitely are. And John, specifically, I just saw your email come through. I'll send you an email. We can talk offline and kind of get you in the program with Quest and make those introductions for you. And we just got another question. Oh, yeah, I'll email you that. Mike, I'll get you that email as well. Cool. Richard.
That's good. Yeah, that was pretty much all I wanted to cover. I guess I thought we were going to get done early, and we didn't get done too early, so apologize for that. But thanks for the questions, everyone.
No, no worries. And, as always, you said it all. I've learned some stuff as always. I know people on here have. And guys, I would invite you as you're digesting this. Richard's one of the most open books I've met in the industry. He'll talk to anybody. Utilize his information here. He's got his direct line. He's got his email address on here. Reach out to him if anything he has said has sparked some interest in you, and continue building that relationship. I have a question. Yeah. Okay. Phil, I'll get you as well in terms of IRA funds and passive investing. But Richard, a kind of a question that comes up a lot. I know it does every day with Quest and the things that we do. There's a lot of uncertainty still in the market.
Right.
And we see, cities and states across the country starting to enact stricter COVID protocol. And we all went through 2020 together. It was one of the craziest years that I've been through since I've been in real estate in 7 years. I know people that have been in the business longer than I have. It was a crazy year. But the question always comes up when we're talking about recession resistant investments. People are always very cautious to say there's nothing that's recession proof. Whether or not we're going to be in a recession, that's another discussion for another time. But historically, when we're talking about assets that people want to be aware of that maybe have proven historically to perform better in economic downturns or times of economic uncertainty, can you speak to that in your experience and things that you've seen in your years in the industry?
Yeah. So I would stay light years away from risky startups and people with some idea they think it's going to transform the world, but they haven't invested their own time and money in getting something off the ground and making it have real revenue yet. Everyone has some exciting idea that they want your money to fund and take all the risk on. I would stay away from those. I would stay away from angel investor clubs. You go there and you just hear people with dreams in a PowerPoint. And there are many business owners out there that have invested their savings, already raised capital, have a proven product, have made, $1 million, $3 million, $5 million a year in revenue, and they would love to have your capital versus the startup who hasn't done that yet. So everyone's at a startup at some point, and yes, they need investors to help the economy go forward. But the mid-sized and small businesses that already have a proven concept are the ones that are going to add the most jobs effectively and not burn your money as much. Less likely to burn your money. So that's one thing that's pretty much true in any market. But if the economy turns sour, it can punish startups more so than some other types sometimes. I also got this question a few days ago, and it's specifically about real estate and what to do if you think a recession's coming and the market's really high. And obviously, we're putting some energy into the hard money lending space. Obviously, that's part of our answer. But the other part is that I would look for something that's just not plain vanilla buying at the top of the market. So instead of just going and buying an Airbnb rental property for yourself or just investing in a few single family residential houses, the strategy I'd like a little bit more is something with extra land around it. So maybe you're buying a house, but it has 2 extra 1 acre lots next to it. Or you're looking at a series of 5 different properties you could acquire, and one of them comes with 4 acres versus the other ones have half an acre each. So I feel like many families do well holding land over the long term, over a 10 or 12 year period. And if you can subdivide and then just sell off that extra parcel of land or develop an extra Airbnb unit on that land, so you have 2 units instead of 1, even if that takes you 5 or 7 years to do so, it's a little bit of extra upside opportunity versus just buying at the top of the market. And then the other thing is that, well, people who allocated at the beginning of COVID were rewarded handsomely. In many cases, it's always good and wise to have a cushion of cash of, 15, 12, 15, maybe even 20% of cash if you do think things are going to come down, so that you're not left flat-footed. And you never want to have to sell something when you don't want to sell it. That's when you usually get damaged the worst. And we didn't have to sell property last year when we were moving from the island to Key Biscayne to Scottsdale, but we tried to, and we tried to sell the property for $1.7 million. No one wanted it at all, and we're like, "Oh, that's too bad. We would have liked to sell it." And now, it's worth 2.3, 2.4 million. So thank God no one wanted to buy it from us last year. But imagine if the situation had been different and we were desperate to sell it. We would have had to sell it for 1.3 to 1.5 last year, and we would have gave up $900,000 of value in that property. So that was a lesson we just accidentally learned. And, it's not common that markets shoot up the way they just did, but don't be caught without enough cash to survive a little bump in the road, because it will come at some point.
Agree. And I think that when we talk about due diligence, something that maybe gets overlooked is risk tolerance. And I think you touched on that, to make sure that we've always got some cash reserves in the bank. Don't kind of get over your skis and going over your head because something may be the next best thing or the greatest thing. There's always the next greatest thing that comes down the pike. But I agree wholeheartedly with you that not only due diligence, but also assessing one's risk tolerance based on your own situation, not where you maybe want to be down the road.
Right.
Living now with that vision for the future.
Right. Yeah. And I like how Warren Buffett says that if you're in the top 20% of your industry or top 10%, or the company you're investing is, and they're a leader and they're innovative and they have an excellent team, they're probably going to do just fine. Maybe they have high leverage. You need to watch out for that. But all things equal, the people who are in the top 5%, 1%, 10%, don't just survive, they thrive through downturns. And whatever, you can take whatever you want from this, but I saw that the top 1% wealthy in the United States grew their wealth by 23% and created $17 trillion of wealth during COVID. And the bottom, I think 20% grew their net worth by 2.3% or something. So in every industry, almost that rule holds true. The winners are still going to win even through a downturn. They might win even more as the correction comes back.
I think that's an excellent point, and point well taken. Guys, reach out to Richard directly. I can't put him over enough. He's a great resource to have. Just listen to what he has to say. Make sure that it's a good fit for you. Make sure your goals are commensurate to what Richard is doing. With us, again, questtrustcompany.com. Look forward to seeing you August 3rd in Houston, August 10th in Austin, August 17th in Dallas. Look forward to seeing you guys in person again. Reach out to us, IRA specialists at questtrust.com. You can reach out to me directly, kurt.power@questtrust.com. And Steve Sabaji, who's on here, I know he's left his information. I can't spell his name, but look in the chat box, steve.sabaji@questtrust.com. If there's no other questions, guys, I'll let you guys get out of here for the night. Richard, thank you so much again, man. It's always great to see you. Look forward to seeing you in person again. And look forward to seeing as many of you as possible as we progress here. Look forward to seeing you in Houston, Dallas, Austin. Talk to you guys soon. Be safe. Have a great night.
Take care, everyone. Bye.